Welcome back. This is Catherine Morgan-Nance. Part 4 of this video series on variable costing examines the differences that occur between absorption and variable costing over 2 years. This video picks up with an example we looked at in Part 3. We'll conclude by discussing other benefits and limitations of variable costing. In our final example, Example 5, we will consider what happens when we produce less than what we sell. We'll refer back to example number 4 that we covered in part 3 of our video series. Please make sure you're familiar with it. This time, assume we are in year 2 of production. Also assume ARCO produces 20,000 units, but sells 25,000 units. It starts the year with 5,000 units in beginning inventory that were produced in year 1, but not sold until year 2. As a reminder, under absorption costing in year 1, the per unit cost of this product was $16, and under variable costing, it was $10. We'll look at year 2 unit product cost next. Let's pause for a moment to consider the cost per unit under absorption costing. You should be experts at calculating it now, right? Recall that when ARCO produced 25,000 units, the cost per unit was $16. However, in year 2, when production declines to 20,000 units, the absorption cost per unit increases to $17.50. And why does it happen? The cost increase is attributed solely to the decrease in production volume from 25,000 units to 20,000 units. Total fixed costs are unchanged. However, at $7.50 per unit produced, fixed manufacturing overhead in year 2 is $1.50 higher than the year 1 cost of $6 because production levels have declined. Regardless, it's extremely important to remember that changes in production volume don't change the fact that the company must still pay for $150,000 in fixed cost. Now, this example illustrates why fixed cost behavior is important to understand. To reiterate, because fixed costs are constant in total, product cost per unit under absorption costing can fluctuate simply due to a change in the number of units produced. The more you produce, the lower the fixed cost per unit. The less you produce, the higher the fixed cost per unit. In this case, we see a higher cost per unit, and we see that production volume affects product cost, which affects management's pricing decisions and profitability. And finally, while we're examining cost, please notice that the variable costing per unit cost are the same as year 1. They're still going to be $10, and we'll see those next, that under variable costing, changes in production volume have no impact on cost. Again, under variable costing, the issue of fluctuating product cost due to production disappear. As you know by now, only variable manufacturing costs are included in product cost under variable costing. And as we'll see next, net operating income will be different again when comparing the two methods because production is different than sales. In year 2, sales of $750,000 are reported under both methods. ARCO sold 25,000 units even though it only produced 20,000 units. Remember that 5,000 units were sold from the beginning inventory. The primary impact of selling units out of beginning inventory is visible in the absorption costing income statement, specifically cost of goods sold. That's on the left. Notice that cost of goods sold of $450,000 under absorption costing contains units manufactured in both year 1, 5,000 units at $16, and year 2, 20,000 units at $17.50. As an aside, while the sale price is the same at $30 per unit, the gross margin for year 1 units is higher than the gross margin for the year 2 units, all because of differences in our production volume. The remainder of our expenses are calculated as we've seen previously based on units sold. Net operating income in this case is $145,000. Now let's examine the variable costing contribution format income statement on the right side. Notice that cost of goods sold is computed using our variable product cost of $10 per unit. This cost is the same regardless of whether the units were produced in year 1 or in year 2. And how cool is that? Variable costing recognizes that fixed costs are constant in total and do not change just because production volume changes. The remainder of our expenses are calculated as we've seen previously. Net operating income under variable costing is $175,000. But wait, this amount is higher than net operating income under absorption costing. Why? Variable costing recognizes fixed manufacturing overhead cost in the period of production, while absorption costing recognizes fixed manufacturing overhead in the period of sale. In fact, fixed manufacturing overheads of $30,000 at $6 per unit incurred during year 1 is reflected in year 2 cost of goods sold under absorption costing. It's no longer deferred on the balance sheet. We say it's being released because the 5,000 units of inventory to which it are attached in year 1 were sold in year 2. And this brings up an important point, which we'll cover on the next slide. When we compare the 2 years, we find that fixed manufacturing overhead of $30,000 deferred in year 1 under absorption costing is released in year 2 because all the beginning inventory has been sold. While profits vary year to year, over the 2 years total profits are $265,000 under either method. And think about this, it should make sense. Over time, when all inventory has been sold and ending inventory is 0, total net income across all periods will be exactly the same, regardless of which method is being used. All deferrals of fixed manufacturing costs will reverse when inventory is sold. This is another key slide to study. I've summarized some important points for you in the chart. As we've seen, net operating income under absorption costing systems is always higher than variable costing systems when inventory increases because fixed manufacturing costs are deferred into inventory. Conversely, net operating income under a variable costing system will always be higher than absorption costing when inventory decreases because fixed manufacturing overhead cost is released from inventory. To summarize, when units produced equal units sold, no fixed manufacturing costs are deferred into inventory, and the 2 methods report the same net operating income. When units produced are greater than units sold, absorption income will be greater than variable costing income. And conversely, as we saw in the most recent example, when units produced are less than units sold, absorption costing income will always be less than variable costing income. By now, you've seen the advantages of variable costing by looking at examples. Here are 3 for you to consider. First, because variable costing categorizes cost as fixed and variable, it's much easier to accurately use for CVP analysis. Specifically, absorption costing assigns per unit fixed manufacturing overhead costs to production. This can potentially produce positive net operating income even when the number of units sold is less than the break-even point. Second, variable costing correctly identifies the additional variable costs incurred to make 1 more unit. It also emphasizes the impact of fixed cost on profits. Absorption costing gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced, but it is not. This can lead to inappropriate pricing decisions and product discontinuation decisions. And finally, variable costing also explains changes in net operating income better than absorption costing does. Production levels have no impact, and we'll compare it with absorption costing on the next slide. As I just pointed out, variable costing income is only affected by changes in unit sales. It's not affected by the number of units produced. And as a general rule, when sales go up, net operating income goes up, and vice versa. On the other hand, absorption costing income is influenced by changes in unit sales and units of production. Net operating income can be increased simply by producing more units, even if those units are not sold. Practically speaking, absorption costing is required for external reports in the United States. International financial reporting standards, we call these IFRS, also require absorption costing for external reporting. Due to the cost of maintaining two separate costing systems, most companies use absorption costing for their external and their internal reports. However, variable costing can be deployed outside of a costing system to evaluate profitability and improve decision making. Well, that's it for our final video in this series about variable costing. Thanks for watching.